Welcome to TheoTrade. This is Don Kaufman. It's September 5th, 2018. We are literally seconds to the closing bell in today's marketplace. Well, this day belongs to none other than the Nasdaq, and the Nasdaq is going to close down just shy of about 1.5%. Some fairly substantial sell-side activity kind of hitting the Nasdaq early on today. Well, is it some of the news-driven testimony in front of the Senate, or is it a long overdue sell-off? Well, one of the things that we can bring to light is that we haven't really seen any sell-side activity in the Nasdaq, or specifically in what we kind of call lovingly the monsters of tech. The monsters of tech consist of Microsoft, Apple, and Facebook, and Google, and Amazon. There's the closing bell. Let's not leave Netflix out of that equation. It's not necessarily one of our monsters of tech, but it did get whacked by 6% today. But the monsters of tech are really what are seeing that sell-side activity. And again, we kind of created this conglomerate symbol. It's really, in effect, our own index. The last time we saw any real sell-side activity, again, you have to look back to late July. Other than that, it's been pretty much a straight shot to the upside. So some long overdue sell-side activity. Now, is there anything to be concerned about? Well, there's something I was pointing out on a lot of recent videos, and I think this is worthwhile mentioning. We're going to cruise over to the Market Watch, and we're actually going to look at S&P 500 sectors. Now, one thing I was barking about heavily this past weekend on the video happened to be specific to advanced decline line, and it also happened to be it's all about market cap right now, right? If you can push market cap, you can actually move markets, and that is not a healthy situation, because it's screaming I'm an illiquid market. Okay, and illiquid markets can get caught either, again, to the upside or to the downside, and you get these feedback loops. Obviously, we've had one of these feedback loops to the upside quite considerably. Now, what's a little bit disconcerting, to me is when you start to look at the sectors themselves. Now, this just happens to be the S&P 500 sectors, okay? There's advancing sectors and declining sectors. Now, the way I look at it, you really only had one declining sector today. So it was everybody get out of the technology boat and put capital anywhere else you possibly can. Well, aside from consumer discretionary, which again got beaten up a little bit today, but the overall theme over here, and what I want to make very, very clear, okay, is that if you start looking at the S&P 100, it's alarming to a degree to see, again, the advanced decline line today is positive, and it was positive throughout the vast amount of the trading session. There was actually one point today where the advanced decline line was 50-50, with the S&Ps down 20 points, okay? Highly, highly unusual. And again, I've seen, through markets, they'll throw things at you, year after year. You're like, wow, I've never seen that before. Okay, well, what do you get that's unusual? The Nasdaq down, over 100 handles with a positive S&P 100 advanced decline line. So at this point in time, some of that sell-side activity, again, it's just isolated, and it's even more isolated than you think. It's more isolated than the entire Nasdaq, because if we pulled up the Nasdaq advanced decline line, which we absolutely can do, you're going to see the advanced decline line is not horrific in here as well. Okay, we have literally a handful of stocks that are giving the market a little bit of a beating. Now, why is that a bit disconcerting? Well, you have to recognize then the capacity of the marketplace. Okay, first and foremost, if you have a portfolio that is heavily weighted towards stocks like Microsoft, or towards stocks like Netflix or Apple or Facebook or Google or Amazon, okay, you have a portfolio manager that has a large percentage of those underlyings, they start to sell those underlyings. If that selling continues in the next day or two, okay, mark my words, it'll spill over into other sectors. Why? Because it becomes a little bit of, again, it's low liquidity, and then becomes a liquidation event where, again, if these are heavily weighted in portfolios, it'll actually cause proliferation of the sell side activity. And what's a bit disconcerting is when you get a positive advanced decline line, and yet the S&Ps are still ending down almost 10, okay, that's a bit scary. Why? because you could get a day very easy if there's proliferation of any sell side activity, a day that were correlated. A day, when I say correlated, when there's 90 decliners and, for instance, 10 advancers on the S&P 100. Recognize what a day like that might look like. That could take the S&Ps down 50 or even 60. Now, this is not like, oh, it's a cautious bearish outlook. This is one, okay, of the insights that we're just trying to provide into what we look at as this continual disproportionate risk reward to a marketplace. And that's all it really breaks down to, is a disproportionate kind of risk reward. And that is, we all have to respect the fact that many of these tech stocks could still have some upside. Okay, but the downside risks, not only to the tech sector, but to the entire marketplace, are becoming blatantly obvious, especially when you start looking at the S&P 100. And I just can't stress this enough. Positive advanced decline line, the S&Ps are down 10. The financials today didn't participate, neither bullish nor bearish. They actually took off out of the gate. We're up about 16 cents, faded throughout the course of the day. But again, imagine, if you will, some of the damage that would be done to the S&Ps if the financials were down with technology being down. Those are obviously your two largest sectors. So let's switch gears for just a second and let's look, okay, at a bit, if you will, of either a defensive play, number one, or just a good shot and a good opportunity. And that happens to be specific to the VIX, and we're going to go look at some VIX options. For the last couple of weeks, I've been pricing out VIX and VIX options and been looking for what we term a VIX volatility spread, pretty much to no avail. I haven't been able to get one on, but what we had change, okay, in the last, really this last few sessions, is that the VVIX, which is the volatility of the volatility index, picked up. What that basically breaks down to is that the options in the VIX are juicier. Well, what does that mean? Their volatility went up. Okay, there's some juice in dem dare options. So I'm going to actually close up this left side bar, and I'm going to build, okay, a what's termed a VIX volatility spread. And what we're going to do is we're going to go out and we're going to go all the way 76 days out in this particular circumstance. And so why am I going so far out in time? Well, it would also encompass the elections. Okay, so the midterm elections would be encompassed in here. And I don't know, I sit back and I think to myself, who doesn't want to buy volatility into the unknown? And now, again, this could be a defensive play. It could also be an aggressive, hey, maybe the market's going to tank kind of play. Take it for what it's worth. Right now, the VIX options, pricing this more effectively. So if I sell the 13 puts, okay, I can turn around and I'm going to buy an 18.22 call spread. Now, this should trade. The market reopens. It should trade for right around even money. What that effectively means is what we really want to pay for this and where I would work the order, okay, is right around zero. And you're like, wait, I don't have to pay anything for this? Well, you don't have to pay anything, but there's still some risk. The buying power reduction for one contract is going to be about $1,300. If you want to clip your buying power reduction off, buy the 10 puts against it. Now, this trade, it'll be right around a 5-cent debit. But now, I just clipped the buying power reduction off to $300. So what does the trade look like? So we're going to analyze it. Okay, so we're going to take this trade, we're going to analyze it. You can see I've been playing around with a whole lot of these spreads lately. Okay, and this is really what the spread kind of breaks down to. For the most part, at this point in time, okay, with the VIX kind of sitting steady between this, it's been 12, 13, kind of 14 region. If it rallies substantially, we can hit a little bit of a home run. If the VIX totally and completely collapsed, obviously we would be taking some risk. However, okay, the VIX itself hasn't, again, all the way back. You got to go all the way back to the beginning of January, really, to see a VIX that's closing even in the 11 region. Okay, so it was down in the 11 region for a brief and fleeting moment. But for the most part, the VIX has had a floor, okay, right and closer to about the 12 region lately. So when you start looking at the risk graph, recognize, there's downside risk. But realistically, it's probably not closing, okay, much lower than about 12, which makes the risk in this trade really favorable versus the reward possibility. That's a $4 wide call spread. So is this, and then when you're looking at the VIX trade, you're like, another bearish trade. Could be construed as a bearish trade, but it could also be construed as a defensive play. And lo and behold, if nothing happens to the marketplace, well, then this trade, hey, it may just go out worthless. Okay, what's worthless? If you close right around that 13.14, the 13 puts expire worthless, the call spread expires worthless, we all walk away clean, we all walk away happy. It's a consideration though, okay, right now, because the market is allowing us to be able to place these trades with the current pricing. Again, think about what we talked about with the S&P 100, the advanced decline line in the days to come. Keep a very close eye on the sell side activity of technology. Obviously, if technology continues to sell off, okay, it is going to start to kick in and proliferate. And that's just portfolio kind of management 101. They're heavily weighted. We all know, okay, that everybody's heavily weighted in terms of passive management into the same handful of stocks. It's one of the most crowded trades in the history of markets. If that trade starts to unwind, of course they're going to start to proliferate out. They're going to start to spread it. And you're not going to see advanced decline lines looking like this. Scary premise, you get 90 decliners, you're going to have a day where the S&Ps are down 50, 60 handles in a day. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.